You know, all of the stats that I know you like to look at in terms of when the market has behaved in the way it has this year, number of new highs, degree of upside, all that stuff by this moment in the year usually has good things to say about what's to come. Is there any reason to think otherwise at this point based on some of the internal rhythms of the market?
Yeah, Mike, thanks for having me back. I mean, we are bullish. We're optimistic. But you're right. I mean, just last week, right, we had 1.6% weekly gain on the S&P, yet less than 200 names in the S&P were higher. Less than 100 outperformed the S&P 500 last week. What's that tell us? Well, maybe there's a little weakening. We know, and a lot of people come on all day talking about this. Tech has done so well lately. Maybe there's some weakness under the surface. But honestly, Mike, I think it's a lot like January. We saw this in January, some weak divergences. But you know what happened? Market kind of went sideways for a week or two, and then stocks caught up and a lot of participation came in. And we still think that's probably the play here.
Yeah, I mean, I know you've been focusing on, as others have, about July and its record of being very strong, pretty consistently for stocks. On the other hand, the final stretch of June sometimes is where you have gotten some choppiness. So what are the relevant things you think to focus on here going into the second half of the year?
Well, you're right. I mean, people are going to hear this a lot. July has been higher the last 9 years for the S&P 500. But in an election year, and I came on with Scott a while ago talking about this, you tend to see your summer rally, right? June, July, August, usually really strong. So we're still in that strong seasonal time frame, Mike. And then I like to look at credit spreads, right? Investor-grade corporates, what's going on there. There's no monster under the bed, right? We're not seeing any major stress in credit markets. We're hitting literally the 30th all-time high of the year for the S&P as we sit here and talk today. So there's always worries, concerns, but bigger picture, we're overweight equities. We have been since December of 22. Mike, we still think there's pretty good upside the second half of this year coming.
And do you think it pays at this point to essentially look beyond the leaders? You know, I mentioned the NASDAQ 100 up another 1.5% here. It just accelerated up higher today on kind of nothing new. And I just wonder if people are kind of capitulating to that particular type of market leadership and leaving the rest behind.
Well, clearly that's what we saw. I mean, last week, tech was up 6%. Real estate was higher, and every other group really didn't do anything last week. So we're starting to see that. We think there is going to be more of that. I don't know if capitulation is the word I want to use, but some of that moving into other areas. We like industrials. We like financials. I know they struggled last week. And then obviously small and mid caps are dirty words a lot of times with the underperformance we've seen. But we really think with the inflation data, you had some guests come on before me talking about inflation, a lot of positive trends. I mean, grocery prices down 4 months in a row, new car prices down 5 months in a row. There are some things happening on the inflation front. Yes, shelter is that stubborn part of it. But if you look beneath the surface, Mike, we think there's 2 cuts coming, September and November. And once that's a little more clear to people with one more probably good month of inflation, that probably can add to that or allow for that broadening out, if you will, of some other groups finally taking the baton back from tech, which clearly is the all-star.
Yeah, I was going to say that seems to be the swing factor is whether, in fact, you get cuts. It seems as if the market has been unwilling to sort of anticipate that moment, I guess, after 11 months when rates have stayed steady. The market's not going to start giving the small caps credit for getting the rate cut before we get it. But we did have yields come down last week, and it didn't help the smaller stocks.
Well, you're right. We saw a 10-year yield lowest level since April. 10-year yield obviously lower also. And you're right. Small caps did not get much of a bid at all. In fact, they struggled last week. We still think, though, there's some opportunity there. And you look at one more thing about last week, kind of looking under the surface, leverage loans actually hung in there pretty well. What in the world does that mean? To us, if there's this risk-off scenario, this major worry taking place, you think there'd be more weakness there. So the fact we didn't see much weakness in leverage loans, yes, it was all about tech last week. But still, there were some positives under the surface there, we think.
Yeah. So in other words, if small caps weakness was telling you something scary about the economy, you would expect credit to weaken up as well. And that hasn't happened. Yeah.
Exactly.